Good afternoon. Thank you for joining us for today's web seminar. I'm Karen Weiskopf, Vice President of Marketing at First Island Investors. I'm joined today by Robert D. Rosenthal, our Chairman, CEO, and Chief Investment Officer, Philip Malakoff, Senior Vice President of Wealth Management and Director of Research, and Edward Gillespie, Senior Vice President of Wealth Management. We hope that 2019 is treating everyone very well so far. We want to take this opportunity to thank our clients for their trust all of these years. We look forward to maintaining that trust and continuing to serve you and your families for many more. Before I hand it over to Bob, I'm going to cover a few quick logistical items. First, all participants are in listen-only mode. Second, after the team delivers the presentation, we will have time to answer any questions submitted. Please don't feel the need to wait until the end to submit your questions. At this point, everyone should see a slide that says today's speakers. If you don't see that, please let us know by typing something in the chat area, and we will do our best to troubleshoot. And finally, our General Counsel has asked that I remind you that today's session may discuss the performance of some strategies and that past performance is not a guarantee of future results. I now hand it over to Bob.
Thank you, Karen, and I'd like to wish everyone on this call a healthy and happy new year. And we're off to a good start, so that should add to your happiness for the new year. The quote that we're using in this presentation is the quote we used in our annual thought piece and our quarterly letter, both of which you should have received in prior weeks. And that quote is from a famous investor named Aristotle, and the quote is, "Patience can be bitter, but its fruit is sweet." Now, I'm sure Aristotle didn't consider himself to be a world-class investor at the time, but we believe his words are quite important in terms of long-term returns to us as prudent investors. So what we're trying to say with this quote is that suffering through either corrections or even bear markets are bitter for all of us. But long-term investors reap the fruit of better returns over the long term by being patient long-term investors, in our opinion. So it's an important quote and philosophy as we go through periods of volatility. And as you can see from the next slide, our agenda starts off with one of those periods, Q4 2018, a disappointing finish, and in our opinion, a disconnect, as we had a severe correction and we're almost in a bear market. Other parts of the agenda for today will be economic positives going into 2019, the wall of proverbial worry, our investment approach, and then as Karen suggested, we'll be happy to answer questions that you may have. If we go to the next slide, and it's an important one. If we take a step back, if you look at the top graph, and you look at the box on the extreme upper right, annual returns, you'll see that despite the pain we felt in the fourth quarter, and for the year of 2018, where we were down 4.38%, or the S&P was, in 2016, the S&P achieved almost a 12% return, and in 2017, almost a 22% return. So despite the pain that we all felt investing towards the end of last year, which took 3/4 of a good year into a fourth quarter, which brought us to a slightly negative year. When you look at the 3-year period, long-term investors who stayed the course did quite well. If you look at the second chart on the page, which is also the S&P 500 index for 2018, you'll see that several things happened during the course of the year. On the bottom, you'll see that we had the passage of the Tax Cuts and Jobs Act, which had a profound effect on corporations, and we believe a very positive one. And then as we hit mid-year, China began imposing tariffs on U.S. goods based on the beginnings of a trade skirmish, or worse than that, perhaps even a war between the United States and China. And then what started to cause the market some real distress took place at the very beginning of October, when rookie Fed Chair Powell suggested that the Fed was a long way from neutral. That scared markets and started markets on a significant downturn. And then we had a very contentious midterm election, which resulted in split government, with the Democrats regaining the House of Representatives, Republicans maintaining the Senate, and of course, President Trump in the executive office. But that also caused some volatility. That, along with what the Fed chair said, continued to scare investors, and they started making a significant exit from investing. And then at the end of the year, we had the Fed announce a rate hike. That was very much anticipated, but when combined with the midterm election and the concern there as to what future policy would be, when combined with the Fed chair saying that we were a bit away from what he considered to be neutral, and with the growing Chinese trade war, investors, many investors, fortunately not our clients, headed for the exits with record outflows, and we'll talk about that later. But then what happened just a few days before the end of the year? Lo and behold, when investors began to realize that business was pretty good, how about retail sales for the Christmas season being up 5%, unemployment dropping again to a new low, all of a sudden we had a Dow jump by over 1,000 points. The S&P jumped by over 100 points in one day. So there was that spike up, as you see on the extreme right of the lower graph. And if you left the markets, if you tried to time things, you missed out on a very significant increase, which was 6.7% in the S&P over the final days of 2018. And this is why we continue to say that patient long-term investors cannot market time. So these two charts suggest that there was great volatility, there was a downturn, then a reversal. But if you take a step back, as we do, and say, okay, we're long-term investors, by having been invested for 3 consecutive years, our returns, when you look at the 3 years, were quite good and quite favorable from a tax standpoint if you are a taxable investor. If we turn to the next page, part of the issue has become that we had very subdued volatility. Now, this chart or graph shows that in 2017, we had very low volatility. And then the beginning of 2018, we had a spike up last year. And then things settled back down. And then again, towards the end of the year, we had a spike up in volatility. This created big outflows from the equity market. And again, people that left during the fourth quarter missed out on the upturn at the very end of the fourth quarter and have thus far missed out on a resilient equity market that's up certainly 7 or 8% since the beginning of the year. But volatility scared people. What did they think back to? The decession of 2008 and 9. And as you know, we've coined the expression decession, which is somewhere between a recession and a depression, and we had big outflows. But unfortunately, volatility is part of long-term investing. It always will be. It's been subdued. It's coming back. And if you have read our quarterly letters and our thought pieces the last few years, you'll know that we have suggested that volatility would return, but it's not something for the long-term investor to be scared of. Now, if we look at the next chart, economic positives. Why are we saying there was a disconnect? Why are we saying that the fourth quarter severe downturn in equity markets, almost causing a bear market, was inconsistent with what we were seeing doing our fundamental economic work? Well, unemployment, which is critically important, especially when you consider that 70% of our economy is driven by the consumer, unemployment is incredibly low. Right now, it's about 4%. The long-term average is 6%, and we were as low as 3.7, 3.8%. And the increase to slightly up to 4% was based on the return to the workforce of many people that had been out of the workforce. That's a very good thing. A matter of fact, a chart that we don't have in this presentation, but we may use in another presentation, is that if you were to go back 15 years and take a look at the number of Americans working, we've hit an absolute new high. So not only have we rebounded from the recession of 2008 and 9, more and more Americans are working as they come back into the workforce and as the workforce grows. That is an important component of economic strength. Another chart or graph that we have is on the lower left, inflation. Inflation is under control. This is one of the mandates of the Federal Reserve. And as you can see from this chart, we've had high inflation at some points, upwards of 4%, just back at the beginning of the recession in 2008. And today we are just about at 2%, which is where the Fed wants us to be. We're probably slightly below that. And as a matter of fact, it was probably 6 to 9 months ago, the Fed was concerned that we would have deflation. So we're on target now with just slightly around 2% or slightly below 2%. That's very important because that also helps direct where interest rates are, which helps us in our valuation work. Another factor that's an economic positive. So we've got low unemployment, real positive. We've got inflation under control, positive. And now we have wages are starting to grow so that our middle class will thrive a bit more. Now, we're not quite at the long-term average of 4.2%. I'm referring to the chart on the lower right. Wages are growing. We're below the 4.2%, but as you can see from the red circle, wage growth is starting to move up, which is helpful. A matter of fact, in the last employment report, where the economy grew by a little bit over 300,000 jobs, wage growth was a little bit over 3% on an adjusted basis, which is, again, an economic positive, and above the rate of inflation. So the spending power of the consumer is greater than the inflationary increase. So this is a pretty positive page of economic positives. If we turn to the next page, as I said a moment ago, the consumer is 70% of the economy, a real force, and consumer confidence is quite high. As you can see in the top chart, you'll see that we hit a low during the recession of 2008 and 9, when the chart shows that consumer confidence was about 40, and now we're well over 100, very high, tempered slightly in the last several weeks based on the partial government shutdown and some of the political acrimony that exists in Washington. But nevertheless, consumer confidence is quite high. Now, helping that, and also another economic positive, is the chart to the lower left. Oil prices have declined, giving both consumers and businesses a boost. As you can see, the red circle on the lower chart on the left shows a significant downturn. And that's important because the cost of whether it's gasoline to drive your car or fuel to heat your home is cheaper today than it was a year ago. And that's a very important catalyst for, again, consumer confidence and consumer spending. A very important chart is on the lower right. Consumer debt is more manageable. Again, considering that the consumer is 70% of the economy, their debt or household debt is at a much lower level than it was at the height of the recession in 2008, 2009. Consumers have basically delevered, and that's a positive thing because they're in a much better or stronger financial shape. So this page shows the positives of consumer confidence is high, oil prices have declined, giving consumers and businesses a boost, and consumer debt is far more manageable. Certainly 3 economic positives. If we turn to the next page, one of the things or concerns that investors had at the end of last year, and all of a sudden out of the woodwork on the cable programs and in the newspapers, started talking about recession. Now, we have consumer confidence high, we have unemployment low, we have corporate earnings growing, but yet there was talk of recession. So we at First Long Island watched this very carefully, and slides later on will go into why we believe there isn't a recession. But as you can see in this chart, gross domestic product started to pick up in 2016 with deregulation from the current administration, as well as then the Tax Reform Act in 2018, which certainly helped business. So we have positive GDP growth. However, it is moderating, but we do not see any signs of recession. Yes, there are some signs of slowing, That's to be expected as we get into a more mature economy, but from our point of view, we do not see any recession occurring, certainly for the next 18 months. But that was something that was bandied about in October, November, and December of last year, which caused investor concern, caused investors to bail out of the market, and they've missed the recent returns. But from our standpoint, we are quite confident that there'll be no recession, certainly for the next 18 months. Now, the next slide is also critically important because it gets to ultimate valuation. Corporate fundamentals are reasonably strong. As you can see, in 2017, S&P earnings were 131.75 per share. In 2018, this index jumped to 160.66. A part of that was operational, and a part of that was based on tax reform. 2019 is showing growth to 169.37. Certainly it's slowing. The pace of increase is slowing, but nevertheless, it's growing. And then in 2020, estimates from FactSet and Standard & Poor's shows 188.33. Again, growing corporate earnings. Corporate earnings are critically important to appreciation in the companies that we invest in. But I want to be candid. We do see some slowing, particularly projected in the first quarter. Share buybacks have been a participant in this growth in earnings per share, and that was driven by the tax cuts. So we have a little bit of a concern that things are slowing a bit, but we are coming off a big jump from 2018. But the bottom line is still growing. That's positive for the investments that we make. And of course, this is for the S&P 500, and the companies we invest in, we believe will do significantly better than the S&P 500. Now, this next page also talks about valuations, which we always talk about. And valuations have normalized. There were concerns that valuations were a bit expensive, well above the average of 15.1, as you can see in this chart. And then we had the massive correction in the fourth quarter, and actually the PE for 2019, the price earnings multiple on 2019 projected earnings, dropped as low as 14.5. With the rebound in the market, we're back to a point where it's slightly above 15. Now, in our opinion, this is reasonable valuation, and in some cases, one could say it's attractive valuation because interest rates remain very low. So if you were to look at this chart, which says that the average PE over the last 20 years or more has been 15.1, the average interest rate or 10-year bond rate, which we follow very carefully, was actually much higher during that period of time. So when we look at interest rates, which we'll go into a little bit later, how low they are and reasonably low that we expect them to be, and you look at where PEs are right now, one could say the equity market is very reasonably priced, not expensive, at least in our opinion. And with that, I'd like to turn over to Phil, who will talk to you about the wall of worry.
Thank you, Bob, and welcome to our clients and friends who are listening today. Thanks for joining us. So there's an old Wall Street axiom which says that the stock market climbs a wall of worry. The more worries in the wall, the higher the market goes. And there are currently a number of items for investors to be concerned with. Rising interest rates, the timing and severity of the next recession, the potential for weakening corporate earnings, strength of the global economy, trade tensions, and policy uncertainty and political dysfunction in Washington are just a few of these concerns that investors have focused on since our last webinar in September. The first we will discuss is the outlook for interest rates. So on this slide, you can see that the FOMC, as indicated by the red numbers, is estimating higher future rates, while the market is expecting rates to stabilize, as the gray numbers show. At the end of this year, the FOMC is predicting Fed funds to be at 2.88%, while the market is forecasting 2.35%, which is basically where Fed funds are currently. If we look out further, it is interesting to note that market expectations are for rates to move a touch lower in the next few years, while the Fed's estimates are for slightly higher rates. As Bob mentioned, the Fed has changed its tune since early December, when Fed Chairman Jerome Powell made a very hawkish statements, leading investors to believe that rates would be rising. Then at the start of 2019, he did a complete 180 and made dovish or more conciliatory statements and abandoned the Fed's predictions of rate rises made just weeks earlier. This laid the groundwork for the Fed to take a break from raising rates in coming months. The Fed also changed policies on quantitative tightening or selling its bond holdings, which is also interpreted as more favorable for lower interest rates. Powell added that muted inflation readings will lead to patience by the Fed as they watch to see how the economy evolves. The labor market is tight, as we saw in a previous slide, but core inflation will likely run below the Fed's 2% inflation target. Inflation expectations in the future drop sharply heading into 2019 as investors realize that lofty profit margins for corporations can absorb higher wage growth, and that may emerge in the future. Additionally, corporate productivity has trended higher. Both will help to relieve concerns about future inflation. All of this points to a pause by the Fed in the rate hike cycle. In summary, there's clearly been a shift away from tighter monetary policy. The Fed is likely on hold for the foreseeable future and isn't on a preset path to push its benchmark rates higher. In fact, just yesterday, former Fed Chair Janet Yellen said, "It is possible that the next move by the Fed will be a cut, not a raise." Another block in the wall of worry has been the impact of the partial government shutdown, which lasted over a month and could resume again at the end of next week. The bottom line on this is that the impact is just not very significant. It is estimated that the shutdown will cost about $3 billion of net economic loss. And there's a delay in $18 billion of discretionary spending, but most of that will occur once the government is permanently open for business. All of this leads to an estimated 0.2% reduction in fourth quarter GDP and 0.4% reduction in the first quarter of this year. While the Q4 loss may be gone for good, the first quarter reduction should be recouped later in the year. Of course, for the approximately 800,000 federal workers who were on the job without pay or were furloughed, this presented many personal financial challenges. However, full-time federal employees will not lose these wages and will be fully compensated. The impacts of the government shutdown will be temporary in nature. It will not have any meaningful long-term effects or serve as a precursor to a significant economic slowdown, as long as a deal is reached in a timely fashion, which we think will happen. The U.S. and China have been discussing and negotiating a new trade deal. There have been ups and downs during this process, which have caused nervousness and volatility in the markets as investors react to the quote-unquote news of the day. However, here's what's not widely known. U.S. exports to China account for less than 1% of what composes the country's GDP, 0.8% to be exact. The EU is a more important trading partner. Other emerging markets are more important trading partners. As a share of GDP, the U.S. just doesn't depend heavily on exports, no matter where they go. As an aggregate, they comprise only about 8% of our GDP. And on this chart, China has the lowest share of that, of all the countries and areas, geographic areas that are listed. And I think that just goes to point out the underlying strength of our $20 trillion domestic economy. Fortunately, investors were granted some relief from the daily news flow as the U.S. and China agreed to a temporary truce and 90-day negotiation period following the G20 meeting in early December. We believe that both sides are incentivized to reach an agreement or an interim deal, as both countries have important upcoming events. The 2020 presidential election cycle will begin heating up shortly, and the Chinese Communist Party will be celebrating its 100-year anniversary. It is also important to the Chinese government to reach a deal in order to boost their economy, which is experiencing decelerating growth. Officials have communicated to local businessmen that they are dedicated to supporting growth via infrastructure investment, tax cuts, and central bank actions. Agreeing to a deal with the U.S. would further support an economy clearly facing structural headwinds. We are optimistic that a mutually agreeable deal will be put in place sooner rather than later. So the next slide talks about the timing of a recession, and one of the key indicators that we follow to determine when a recession is going to occur is the shape of the yield curve. Is it steep? Is it flat? Has it inverted? One sign that a recession may be on the horizon is an inverted yield curve, particularly when the 2-year Treasury is at a higher rate than the 10-year Treasury. History tells us that the U.S. will enter a recession 9 to 18 months after this happens. This chart shows that when the Fed is raising rates, which it is currently, as shown by the lighter blue line, the spread between 2s and 10s narrows and can invert or go negative. This has happened 6 times since 1977, and in 5 of those times, the economy has entered a recession, as noted by the gray shading. Recessions have occurred on average 14 months after the first inversion. The 2s-10s spread has narrowed over the last few years and was 17 basis points this morning, but it hasn't yet inverted. And there is history for the spread remaining near inversion, but not going negative. Beginning in late 1994, the spread broke the 60 basis point level, quickly going to 9 basis points at year end. It subsequently moved higher, and for most of the next 3.5 years was under 60 basis points before inverting in May 1998. For reference, the 2s-10 spread broke the 60 basis point level in late 2017. One of the economists who we follow and whose opinion we greatly respect recently published a piece stating that he expects the yield curve to steepen. He believes that short-term rates will stabilize at current levels as the Fed pauses its rate tightening cycle, which we discussed previously, and longer-term rates will drift higher as economic confidence is gradually restored. He believes the spread between 3-month T-bills and the 10-year Treasury, which was 26 basis points this morning, could widen to more than 100 basis points by mid-year. Because of this, he has pushed out his expectation of the timing of the next recession from late this year, early next year, all the way out until 2021 or perhaps later. A deferral of the next recession beyond 2020 is not priced into financial markets and would have a monumental impact on investments. This would favor risk assets, such as U.S. equities, over safe haven assets. It would extend the bull market and common stocks by years. Now, that's one person's opinion, and whether his opinion proves to be accurate or not, one thing we do believe is that the next recession will not have the depth or length of the Great Global Recession, or, as Bob called it, the decession of 2008-2009. The severity of the next recession will be mitigated by the underlying strength and resiliency of the economy and financial system. We believe it will be short, lasting 2, possibly 3 quarters at most, with GDP barely moving into negative territory and in no way approaching the levels realized in 2009. That recession was driven by a systematic lack of liquidity, which we are no longer experiencing. So this chart should look familiar if you participated in our calls before. It talks about volatility, which is a very important factor that we watch closely. So this chart shows the actual number of days when there was a greater than 1% range in the S&P 500 index. The average for this over the last 25 years is 124 days a year, a figure which hasn't been reached since 2011. In 2017, we experienced historically low volatility by this measure, with only 10 such days, well under the average and well under the previous annual low of 40 days. In 2018, volatility increased to 110 such days, with 50, as you can see on the right, occurring in the fourth quarter alone. To take this a step further, in 2017, there were exactly 0, no days, with a daily fluctuation of 3% or more, but there were 15 in 2018, and 10 of those occurred in the fourth quarter. So volatility did pick up a bit last year, but on a historic basis, it was less than average. However, it did feel worse than it actually was, as almost half of it occurred in the last quarter of the year. Increases in volatility tend to occur when there are dislocations or shakeouts in the market. Going forward, we expect that investment markets will experience bouts of heightened volatility, and so far this year, there has been a bit of volatility in the market, which has been moving higher, and there have been 11 days with greater than a 1% range during the first month of the year. But this isn't unusual, and those of us who were investing in the late 90s remember when volatility was high as equity markets were soaring, so it can work both ways. Another important factor to bear in mind is last year's midterm elections, and this slide shows how equity markets performed following midterm elections, as well as how much they correct leading up to these elections. In each midterm election year, the market has advanced by a minimum of 9%, with an average return of 31%. Why is this? Well, we believe that coming into these important periods, there is an uncertainty. Who will win? Which party will gain seats? Will the House or Senate have a change of control, etc.? In equity markets, they just don't like uncertainty, and this is shown in the market drawdowns that occur as we approach each of these elections. The average correction for midterm election years is 19%, and leading up to last year's elections, the markets experienced a 10% pullback, and following a short rally, continued to fall post-election as Congress was split, with the House falling under control of the Democrats. The total pullback in 2018 was 20%. However, once elections are decided, there is certainty and investors can feel more confident about the direction of public policy going forward. Political certainty is typically rewarded with higher equity prices, and 1 year after midterm elections, stocks are higher by an average of 31%. You may recall that equity prices were sliding lower as we approached the 2016 presidential election. But once the election was over and a new president elected, equities advanced strongly, gaining over 20% in the next 12 months. This cycle has been repeated over and over again. But that being said, history is a guide and not a guarantee. There are other blocks in the wall of worry. Investors fret about weakening earnings. But as year-end 2018 earnings reports are concluding, companies are reporting very strong results and guiding towards 5% growth in 2019 and double-digit earnings growth in 2020. Global economic weakness, the effects of Brexit, political dysfunction in Washington are additional areas of focus for investors. So thanks once again for joining us. I'd now like to introduce my colleague, Ed Pileski, who will discuss our investment approach.
Thank you, Phil. As you know, we customize an asset allocation for each individual client based on their different needs, goals, and risk tolerance, along with how we view the market. Our roadmap is how we define the investment landscape, and these 4 baskets are how we allocate your capital. Through a prudent asset allocation, our goal is to protect and grow your assets over the long term. So as we move from left to right, we expect each of these baskets to provide better returns over the long term with more risk. Starting with the first basket, security investments, we recommend maintaining an underweight with a focus on quality and short duration. With rates still low, not many attractive return opportunities exist at this point, especially on an after-tax, after-inflation basis. Moving one basket to the right, we have our defensive strategies, which are designed to participate in the upside when the equity markets do well, but protect and mitigate the downside when the equity markets are down. We're recommending clients overweight exposure to our defensive strategies, where we feel we can achieve good returns while taking on less risk. And then we have traditional equities, which we are very modestly underweight. While our first priority is to preserve capital, valuations are reasonable, and we still believe long-term opportunities exist, and a meaningful allocation remains appropriate. The final basket is private investments, which we'll utilize as appropriate, and we remain opportunistic where it's suitable for certain clients, as it's typically less liquid while providing diversification. Continuing on with our investment approach, emotions need to remain in check. Emotional reactions to market fluctuations can range from greed to fear to hope, which can often lead to bad decision-making. This graphic depicts how emotional investing can resemble a roller coaster, where the challenge is to stay on track and not have your long-term investment goals go off the rails. Committing to a well-defined and customized prudent asset allocation enables you to stay the course through market volatility, often resulting in solid performance returns and enabling you to achieve long-term financial goals. An effective way to avoid emotional investing is by working with your team at First Long Island Investors to discuss your asset allocation to ensure it provides you with financial peace of mind and enables you to sleep at night. Allowing emotions to drive short-term investment decisions could lead to greed, enticing you to buy high, which, as you can see on the graph, is when you're at your highest level of financial risk, or fear, allowing that to take over and make you sell low. Another way to avoid acting on this emotional behavior is not to overreact to the noise, a la the media coverage, especially during a downturn like we had in the fourth quarter of last year. Instead, focus on the fundamentals of the company. Oftentimes, the best time for investing is when there is fear or panic in the street. Case in point, with the threat of a global economic slowdown and the escalation of the trade conflict between the U.S. and China, this created an opportunity to establish aircraft manufacturer Boeing as a position within our dividend growth strategy in the fourth quarter of last year. The negative sentiment pressured the stock, and the valuation became attractive. While China represents a significant portion of Boeing's aircraft deliveries and backlog, the concern that sizable cuts would occur to new and existing orders in a trade conflict were overblown. Boeing's multi-year backlog and its industry's duopoly structure is helping to somewhat protect Boeing in a trade conflict, as China would put itself at a disadvantage by reducing its orders with Boeing. We love Boeing's cash flow generation and the global secular story. Since we've initiated the position, we've been rewarded with a 20% increase in the dividend, and the stock has meaningfully risen and recently surpassed earnings expectations and raised guidance. So thus, the noise can create an opportunity. We want to take acting emotionally out of the equation, particularly in the face of turbulence within the market, by being properly allocated amongst our respective strategies. As Bob mentioned, you cannot time the market. This chart shows the importance of being invested and not attempting to time the market. If an investor missed just the 5 best days in the market within this 23-year period, it can have a substantial impact on your compounded annual return. You can see if you were fully invested at this point in time, you had a 7.3% return, but if you missed the 5 best days, you had a 5.5 compounded annual return. So not being invested for just a few of the best days in the market can impact your performance in a material way. As I mentioned earlier, we are indeed underweight fixed income. One of the main reasons why we remain underweight fixed income is that when you take into account the current inflation rate of 1.9%, which is represented by that gray line across the bar chart, the current yields on bonds remains attractive. The 5-year U.S. Treasury and municipal bonds are below or at the current inflation rate on an after-tax basis. You can see on the far right, when you take into account the tax-exempt yield on investment-grade corporates, the yield is better, and we're finding better opportunities on a select basis amongst investment-grade corporate bonds. We continue to recommend fixed income as an important yet underweighted component of our clients' diversified asset allocation. We do this to offset market volatility and to generate a consistent stream of income and to preserve capital. This chart demonstrates the importance of compounding returns. If you invested $1 million starting in 1997, this chart effectively illustrates the power of compounding over this 21-year period. with the S&P representing the blue line, which has materially outperformed the 10-year Treasury and the 90-day T-bills. As we turn to our approach regarding our defensive basket, which we're currently overweight, we believe that our defensive basket provides our clients with reasonable appreciation potential while mitigating volatility with its defensive characteristics. The defensive strategies are designed to mitigate volatility with lower beta than the broader market, minimize downside capture, which is the key to protecting wealth in market downturns, while in an up market, capture a significant portion of the market appreciation. Examples include hedge growth, a bias to growth companies. Example would be a long-short strategy. Dividend growth, a bias to value companies, investing in high-quality dividend-paying stocks that have demonstrated sustainable growth in dividends over time to achieve superior returns. The goal here is to limit downside capture while maintaining significant upside capture. Thus, even if volatility continues to pick up and stock prices fluctuate, these companies are increasing their dividends on an annual basis well above the rate of inflation. And our last example is on multi-strategy hedge investments, a bias to credit. An example here would be investing in distressed credit. Dividends provide a defensive nature to this investment have contributed a great deal to total return. This is the S&P total return that's comprised of both dividends and capital appreciation. And you can see over time, dividends have been an important part of the total return total. We're continually looking for companies with attractive cash flow dynamics and managements that are committed to returning cash to its shareholders, and that dividend yield is certainly important in providing a defensive component to this approach. As Bob had stated earlier, this chart shows you the current PE versus the 20-year average PE, and it's one reason why we're maintaining an allocation to traditional equities. We feel these valuations, although no longer cheap, are certainly reasonable. As Bob stated earlier, valuations have normalized, especially in an environment where interest rates remain low. And to continue with our current approach, we are indeed maintaining an allocation to traditional equities biased to growth companies with an underweight towards international. This chart continues to demonstrate that the domestic indices, such as the Russell 1000 Growth, the S&P 500, and the Russell 1000 Value, have dramatically outperformed the international indices. We've been correct and been rewarded over the last several years as the U.S. economy continues to recover and grow as compared to the international economies. And as Bob mentioned earlier, you could see the period. This chart also shows that the market can and will go down for a period of time, a la the recession period during the financial crisis. But if you're patient and you invest in quality companies along with the proper asset allocation, you can indeed come back and make substantial returns over the long term. And our final slide on the current approach talks about the power of compounding. The chart effectively demonstrates the importance and the effects of compounding over a long period of time, as equities have meaningfully outperformed both bonds and cash, and that is certainly captured on the 20-year basis, with stocks, again, materially outperforming both cash and bonds. I will now turn it over to Bob to discuss the summary.
Thanks, Ed, and thanks, Phil, for those really good presentations that were chock full of information that I'm sure our listeners will dissect and absorb. But in summary, 2018 ended with sharp declines across all equity markets, irrespective of strong fundamentals. And that's why we believe there was a disconnect. Many of the slides and information we've presented to you demonstrate that the U.S. economy, and for that matter, the global economy, remains fairly vibrant. The consumer is strong, businesses are strong, and very importantly, our banking system is very strong. So the disconnect took place. Those that stayed the course have now seen a reversal where we have gains. U.S. GDP and corporate earnings will both continue to grow in 2019, albeit at slower rates than in 2018. We think that's already digested in the marketplace. But the key is we don't see recession. We see GDP continuing to grow and corporate earnings continuing to grow in 2019. Companies will continue to reap and invest the benefits of the Tax Cuts and the Jobs Act of 2017, and individuals will begin to see the benefits in 2019. As an example, Home Depot, which employs some 300,000 associates, recently stated that virtually all of their employees did not adjust their withholding so that too much was withheld based on the change in the tax law, which reduced tax rates for the average taxpayer. The benefit of that will be seen by those associates, some 300,000 of them, just for Home Depot in April of this year or when they receive their tax refunds. So there's more good stuff to come for the average consumer in 2019. And as stated earlier, the consumer is 70% of our economy. As Ed presented, valuations are near the historical norm and in some cases attractive. Going back over 20 years, as those charts did, in virtually every category, we're slightly below the PE average of the last 20 years, with the exception of just small cap growth. So from our standpoint, valuations are at historical norms, some cases attractive, and when you look at long-term interest rates where they are right now, that probably makes it even a bit more attractive. As Phil pointed out, volatility will continue in 2019, somewhat dependent on domestic and geopolitical headlines. So 2017, we had abnormally low volatility. 2018, it started to pick up, and in particular, as Phil pointed out, in the fourth quarter. And in 2019, we're seeing greater volatility, but also, as we pointed out, the volatility thus far this year has been with a positive trend. Concentrated portfolios of companies with strong fundamentals should prove successful over the long term. Whoever suggested you can't be a long-term investor several years ago was absolutely wrong. We can give you examples of many companies that we invest in. Apple, as an example, MasterCard as an example, who have just grown and grown over the last 10 or 15 years, much to the benefit of all of our clients. So we believe if we have concentrated portfolios of our best ideas between us and the outside managers that we work with strong fundamentals, it'll prove to be very successful for our clients over the long term. As we've also stated, and this is particularly important, we do not see a recession for the next 18 months. The fundamental components of the economy between consumers, businesses, and our banking system, and the balance sheet of our banks and the balance sheet of our consumers make us believe that we will not have a recession for the next 18 months. We remain committed to selective opportunities in real estate and private equity, as reflected in that fourth basket that Ed showed. And we believe being patient with a prudent asset allocation with an overweight to defensive strategies, given the increased volatility and given that pretty big wall of worry that Phil described, is the best course for most investors and for our clients. And now I'll turn it back to Karen, and we'll be happy to answer as best as we can any of your questions.
Thanks, Bob. Thank you to Bob, Phil, and Ed for sharing all this information. We will begin to answer questions. If you have any, please type them into the dialog box on your screen. So one question we got was that in an earlier slide, we discussed how, and we saw a chart that showed that the domestic indices have outperformed the international. If you believe that at some point there will be regression to the mean, why are you underweighting the international?
I'll take that for a moment. We maintain an allocation in several of our strategies to international with a component invested in emerging markets. However, up to this point, and we've been right on this, I think, for the last 10 years, we believe that and don't shoot me for saying this, the political stability in our country as compared to other countries, whether it be Brexit, whether it be China, whether it be the EU, there's been a lot of strife politically around the world, but the United States still has represented the most stable of economies and the most stable of political systems. And for that reason, we saw and continue to see significant opportunity domestically. We watch this very carefully. We work with several consultants, and we have 2 outside international large cap managers, and we speak with them at least on a quarterly basis. And within our strategies, we do have some international component. When we see a valuation disparity that attracts us enough to take on the currency risk and perhaps the political risk, we'll increase those allocations. But right now, we have been able to do well for our clients, being primarily invested domestically. And keep in mind that even when we own a domestic company, such as MasterCard or Visa or Qualcomm or Apple, guess what? Much of their earnings and sales are derived from overseas, but they're domiciled here in the United States. So at this point, we're maintaining what would be considered a below average allocation to international. Thus far, we have been right for now 10 consecutive years by underweighting international. If we're a little bit late to the party in increasing that allocation, that's okay because we're way ahead of the game thus far. But we do discuss this almost weekly at our investment committee meetings, and if we see valuations really become more attractive internationally, we'll increase that allocation.
Great. So to be respectful of time, I think we have time for really just one more question, which is that we talked about overweighting defensive strategies. Does First Long Island feel that is right for all investors, regardless of age and or investment goals?
Well, I think that each client's needs, goals, risk tolerances are different, so everything should be done on an individualized basis. But given the fact that we feel, there is going to be volatility, there are going to be ups and downs, we'd like to see a smoothing out of all clients' returns and not experience the big ups and downs. So, we would recommend that each client have an exposure to defensive equities or defensive strategies. And, we have clients that are under 10 years old. We have clients that are over 90 years old. And our dividend growth strategy makes sense in some respect for every one of those and all ages in between. It's really what allocation should it be is the main question. And so, once again, it's very individualized. And to give a further explanation would really require too much time than we have for purposes of this call. But if anyone is interested in discussing their personal allocation with myself or another member of the FLI team, please feel free to reach out to us.
Yeah, let me add one last point to that. Just because something's defensive doesn't mean you can't get a more than adequate return. And thus far, if you look back in history over, I think I'm allowed to say at least dividend growth, the return, and I say that because we're legally constrained as to what we can say about certain things, but if you look at our defensive basket, we have certainly delivered reasonable returns in good markets, and we have mitigated risk to some extent in bad markets. So we're not looking to have a very low return for our clients. We're looking to have the right risk-adjusted return for our clients. And as we see things, as Phil pointed out, given the volatile world that we work in, where you do have partial government shutdowns, you do have trade wars, you do have political acrimony, being somewhat overweighted in defensive strategies that still deliver a good return, we think makes sense because our first priority is always to preserve your capital and then to grow it at a reasonable pace over the long term. And we believe that all of our strategies, when put together in a prudent asset allocation, will deliver strong or reasonably good long-term returns over the long term.
Great. All right. So thank you to everybody. On behalf of the entire FLI team, I want to thank you for joining us. We hope you found this session interesting and insightful. If you have any friends or colleagues who you think would benefit from joining future events, please let us know and we can include them. And I'll reiterate what Phil just said, that for our clients on the line, if you'd like to speak through your individual situation, are there any other wealth management needs we can be of assistance with, please give us a call. Thank you so much, and we hope everybody has a great afternoon.